constantly learning, Josh. I think I learn something new every day. For me, the biggest thing I think is the importance of having a really strong team. It really, I'm used to doing a lot of stuff on my own, and I learned fairly quickly that in real estate, you can't do very much on your own. Like you need a strong team to support you. There's the accounting side, the bookkeeping side. You need relationships with brokers. You need good property managers. You need contacts in the construction world. You just really need to build a team of people to support you, a good CPA. All of those things are really important. So I'd say probably the biggest lessons are around finding and building a strong team, finding people that have integrity that you want to work with, and just getting those folks in your corner early on.
Welcome, Real Estate Hustlers Podcast. I'm your host, Josh Appelman. Today we are joined with Jason Canley. Jason is a seasoned real estate investor with over 1,200 plus multifamily units in the Midwest. He's backed by 20 years of Fortune 500 financial analyst experience. And Jason, we appreciate you coming on the show today. If you could, let listeners know a little bit more about yourself.
Yeah, sure, Josh. It's good to be here. I appreciate you having me on. So I am calling in from just outside of Nashville, Tennessee. I from the Northeast originally, born in upstate New York, grew up in New Jersey, moved all around the U.S. We can talk about that a little bit later if you like. And now currently residing in Nashville.
Okay, got it. So let's start way back in the beginning era of your real estate journey. What made you want to get into real estate, and I guess what size property did you start with?
Yeah, so my journey in real estate probably started, I'd say, about 2019. And at that time, I was still in corporate America. My wife and I were still in corporate America. Had our first child on the way, and we're kind of reevaluating our situation. So we were, chasing one promotion after the next. Spent about 15 years doing that. Relocated around the country, I think 5 times in about 10 years. And it was good. We were earning a great living, having a good time, taking some cool vacations. But there was a couple of problems with that, right? So the first one really was just burnout. We were getting tired of moving around. My wife is in medical sales, and for anybody who's familiar with that industry, you kind of know that sales comes with a lot of travel. And my wife's role was really no exception. So she was on and off an airplane about every other week, and it was starting to take its toll on both of us. And it's just a tough pace to maintain long term, and we were just kind of getting burned out with it. So that was the first problem. Second problem was we didn't have really any passive income coming in. All of our income was tied to our W-2 jobs. And the third one was the income the wealth that we had built up until that point was really tied up in retirement accounts and locked away in a 401k, primarily in equities in the stock market. So, having a corporate job, that's really your primary mechanism to lower your taxable income is invest in 401ks. And so we maximize that. But none of that income really helped us, or none of those assets really helped us. And so with a little one on the way, we were kind of reevaluating things and trying to figure out how we could make some changes. And that's ultimately when we decided to invest in real estate, right? So we decided to take the incomes that we had spent, quite a few years building and start buying assets that generated income for us. And some people do that, buying businesses and other things, but for us it was real estate. And so I started taking some educational courses and spent a couple months doing that. And then started ultimately with single family residential. So, the ugly houses in the nice neighborhoods, we would buy them and renovate them and rent them and bring in a property manager to manage them. And we did that, and we're doing well at that. I actually still have those properties today. But what I didn't realize at the time is what I had actually done was create a second job for myself. So it was definitely throwing off cash flow, but it was anything but passive. And we started looking around for other ways to invest in real estate that weren't consuming so much of our time, my time specifically. And that's really when I switched over to apartment investment, specifically apartment syndication. And I know primarily your audience is familiar with that, so I won't go into too much detail about what that is. But it's really just partnering, a partnership between two groups of investors, limited partners, general partners. Limited partners bring in some of the equity, help the GPs take down the property. So I started looking into syndications, familiarizing myself with those. Since then, we've, as you mentioned, invested in about 1,200 units, 5 or 6 different syndications across the Midwest. And it's really been a game changer for us. I mean, the returns have been better than our single family portfolio. The overall returns are better. The cash flow is better, and ultimately it doesn't take up nearly as much of my time. So that's really where we are today, and that's ultimately why I started my company was to help other folks in my scenario, my background, get exposure to those kind of investments.
What year did you start investing with the GP, a sponsor?
About 3 years ago.
Okay, that's a interesting time to get in.
It is, yeah.
So, what have you seen? What has your experience been so far with the properties that you've I'm going to say helped purchase with your equity?
Our experience, fortunately, has been really good, Josh. And you hear horror stories. I've heard some about limited partners and who've lost some or all of their equity. You hear about capital calls and all sorts of things. My experience has been really good. And I chalk that up to a couple of things. First and foremost is education. So for me, I like to educate myself before I do anything. So I spent a lot of time just getting up to speed on apartment syndications and joined some mentorship groups, hired a coach and an advisor. Really got familiar with syndications and how they work, and did that for probably about a year before I actually even started investing. And then from there, it was really just doing some due diligence. So I identified some markets that I liked. And then from there, found sponsors within those markets, took my time, had phone calls, found folks that I liked, I trusted. And then ultimately, I kind of developed my own investing framework. I call it a SMART framework, but it really just stands for structure, model and assumptions, alignment of interests, risks, and then the team. And it was just a model that I used to kind of look at every syndication kind of in the same way to help me mitigate my risk. And so I went through those steps and then started investing. But the investments I've been in have been strong investments. There haven't been any problems, no capital calls, and I've had a really good experience up to now.
Well, and that's a direct result because of the due diligence that you put in before investing, for sure. Because the operator is everything on any deal. The operator is going to know which deals are winners and losers just because of their experience too. So, and then you got your education, you went through, you got your mentor. What kind of due diligence did you do with the operator before you decided to pull the trigger, invest into not only them but the deal?
Yeah, so for me, just dealing with people that have integrity. So I like having conversations. I feel like you can tell a lot about people just by having conversations. But that's only the beginning. Obviously, you want to look at people's track record. I like people that have invested through multiple investment cycles, right? Not just one. Anybody can invest on the way up and make money and look good. But so I like people that have been around for a while. Check references, ask to speak to some of their investors, check reviews, the typical due diligence that you would do. I like folks that invest in their own deals. I wanted to see the results of what their last deals were, not just what their projections were. So, hey, here's what you projected, but how did those deals actually turn out? And asking questions around what deals didn't perform well and why. I know some people shy away from GPs who might admit that deals didn't go well, but I think that's probably the wrong approach to take. I think you want somebody who's kind of weathered some storms and who's proven that they can navigate that. Anybody who tells you that they've never had a problem and everything's always gone well, to me, that's a red flag. So I like when people are honest. I like to hear honest opinions from folks, and so that's some of the stuff that I asked when I was evaluating sponsors.
The 1,200 units, and that's, you said 5 different sponsorship groups, GPs. Yeah. So, and then the Sun Belt. That's a large portfolio to be a sponsor on. Are these $25,000 increments, $50,000 increments, 5,000?
Yeah, so it's 5 different syndications, but only 2 different sponsors. Okay. So I primarily invested with 2 different sponsors in the Midwest. So I'm in Nashville, but most of these are either in Ohio or in Indianapolis area. And they're fairly large properties. One was a 444 unit. A lot of them were in the 300 unit range. They're large properties. And investment minimums for those were primarily 100,000, but there was one $50,000 investment.
Got it. So for the listeners that are listening in, wondering how they can get into it, because you got into it as you've got your active income, you're building up capital in order to invest, in order to generate passive income. So with your experience now, how would you recommend a beginning real estate investor get into real estate?
My advice, you really need to look at what your goals are and then find a strategy that works for you. And for me, syndication made a lot of sense because I had a corporate job, I had a young family, I had built up income to invest, tried going the active route, realized I had just created a second job for myself. And so syndication for me was a no-brainer. So I think you just need to think about like what your goals, what your objectives, and then find a strategy that really works for you. For me, I wish I just would have started earlier. It's not something I knew about. It's one of the reasons I said earlier I started my company is I just didn't know these types of investments existed. For me, it was either, flipping houses like you see on HGTV or becoming a landlord. Like that was my universe of real estate investing. And I didn't know about syndications, apartment syndications, and those sorts of things. So one of the reasons that, I've gotten into it now is first on the passive side, but now also to bring those opportunities to other people that have a background like me. I've spoken to a lot of VPs and directors and general managers, and most folks with a corporate background that I've interacted with have no idea that these investments are even an option.
Yeah, because it's almost like the saying, the teacher will appear when the student is ready.
Yeah,
And that's if you're not looking for it, it's not there anyways. But when you are looking for different ways to invest, different ways that can throw off cash flow, that's where it's like, here's multifamily. What's that about? So then you go down a rabbit hole. And now you're getting on the active side of it, the active management side of it. Is that correct?
I am, yeah. So we're acquiring multifamily properties for our own portfolio, and I'm looking for opportunities to partner with limited partners and other GPs to do some deals as well.
So did you transition out of your active income job into just passive, and now you're building a different career, or how is just for the listener's sake, how is your path going so far?
Yeah, so that's a great question. So when I had initially started, I was probably investing, I'll call it on the side while I was still working my W-2 job for about 2 or 3 years. And over the last 2 years, I've since left my W-2 job and have been investing full-time through my company. So I would say full-time without the W-2 in the picture about 2 years now.
Got it. And then you're investing, well, your company is investing into these syndications on your behalf or active properties on your behalf?
Not quite. So the company is on the active side, and it's primarily in a management function, but I take ownership in another entity. It's more of a holding entity that I take ownership in the actual syndications.
Got it. Okay. So what are you envisioning? Being vertically integrated, or you've got your asset management side, your property management side, all under one roof, or what are your
ultimately vertically integrated? So I love the Tennessee markets, specifically Middle Tennessee, and my objective is to acquire enough properties that are closely enough, located geographically located where I can do vertical integration. So ultimately property management, but certainly asset management, and then maybe some stuff on the construction side as well.
Yeah, Nashville market is it keeps growing year over year. It's incredible.
Year after year. Yeah.
Is there any land left?
You know what? That's the crazy thing, Josh, is there's a ton of land here. There's just a ton of land. There's a lot of room to build. A lot of the counties in Middle Tennessee are like some of the fastest growing counties, and there's still plenty of room to build. The job market here is good. It's a business friendly place, and people are still coming. People still want to do business here. They want to move here, and it's just a great place to invest. I think Nashville's got a little bit of a bad rap. You hear about the oversupply, and certainly the urban core, so the central business district has gotten a lot of inventory over the last year, and some more of it is coming online this year. But it's being absorbed pretty quickly, and a lot of the areas surrounding downtown Nashville just haven't gotten the attention from the developers, and they're still getting pretty decent rent growth, and it's still a great place to invest.
Yeah, there's in downtown Cincinnati, there's a lot coming online as well, and then you hear like news outlets say that the people are moving out because vacancy is going up, and it's not, vacancy is not going up. People or there's now new supply, so
Yeah.
And people don't realize that, but on the outside, you'd think that people are moving out because vacancy is going higher, but they're scattering out, taking advantage of the lease up sales.
Yeah.
So there was a deal from Nashville, a group had sent me, I want to say probably 4 or 5 months now, but the reversion cap rate was like 5.5 on a C plus, I'm going to say a C plus workforce asset. And those just, no matter what, a 5.5 cap doesn't exist on C plus anything, workforce or not. It's just, you got to be wary of, you have to know what the deal is. You have to get education, know what you're looking at, know what you're looking for. Know the industry, know the market, but then also know when to pass and just move forward. Because getting out of that deal at a 5.5 cap reversion, the buyer would have to be. You're just not going to have a buyer that's institutional level. It's going to buy an older vintage asset, and then at that cap rate.
If they're even interested in that vintage of an asset, right?
Right.
What I've been hearing lately is most of those institutional guys aren't even looking at those older vintage properties. They're just not. They get
them off their balance sheet. If they're a certain age, they throw them off the balance sheet and just keep churning. But those are things to be aware of because those are out there, and all it does is make life extremely difficult 3 to 5 years down the road when you're supposed to cycle out. So just know what the underwriting looks like, know what the group's capable of doing. Did they do it before? If so, then when? If they sold an asset during the 2021, 22 time era at a 5.5 cap, that was probably just this moment in time. So
you're absolutely right. It's interesting too, Josh. A lot of the statistics you hear are like national statistics, but every market is different. I mean, it's good to know what's happening generally in a specific asset class, but every market is a little bit different, and there's sub markets within markets, and so you really need to know where the investment is. What assumptions are being made. To your point, it's one of the things I talk about in my SMART framework. Like cap rates are an assumption that sponsors are making, and that factors into the projections or I should say the returns that they're projecting. And it's one of the levers that can be pulled to make returns look better maybe than they should be. And so investors, limited partners need to know where to look, what questions to ask, and what those assumptions are.
Yeah. Especially like you had mentioned, the pockets within the submarket, because it can go street by street. And if you invest on the wrong side of the street, then you can get stuck in that asset. It doesn't matter what you've done to it, how much the rents are. People just might not want to deal with the nonsense. So it's just being aware. What are some learning lessons that you've learned along your path so far?
I'm constantly learning, Josh. I think I learn something new every day. For me, the biggest thing I think is the importance of having a really strong team. I'm used to doing a lot of stuff on my own, and I learned fairly quickly that in real estate, you can't do very much on your own. Like you need a strong team to support you. There's the accounting side, the bookkeeping side. You need relationships with brokers. You need good property managers. You need contacts in the construction world. You just really need to build a team of people to support you. A good CPA. All of those things are really important. So I'd say probably the biggest lessons are around finding and building a strong team, finding people that have integrity that you want to work with, and just getting those folks in your corner early on.
I totally agree. It's especially vertically integrated. There is the armpit of the business. That's the management side, and it's not to be desired. But if you can do it efficiently, save money where others can't, your returns will shine through. And I think that's the biggest piece, because you put property management in front of you. You're relying on them to hire on your behalf. You're relying on them to pay bills on your behalf. So no one cares more than you. So if anybody's wanting to squeeze expenses, it's going to be you. It's just you're buying a job at the same time, but you're also building wealth, building cash flow, building time. So and preserving the asset. How big do you see your portfolio getting as you scale?
I mean, I don't have a specific number of units or assets under management. I want to grow a company that that can really provide the outcome that I'm looking to provide, and I really just want to help as many people as I can that came from a background as myself, get exposure to these types of things, build wealth, have freedom and flexibility in their life, and be able to do it in a way where they're not just stuck to their W-2 job or investing in the stock market. So I'd like to grow at a stable rate. I'd like to grow in a way that that enables me to continue growing, to not get out too far out in front of my skis, but really it's just to help as many people as I can, Josh.
Yeah, that makes sense. I mean, there's a lot of people that use their active income to then invest and make sure that that's growing while they're out there getting it too, creating cash flow to invest. Very cool. For the beginning real estate investors, what journey, what books do you recommend that they read? What mentorships? How can they get started?
Yeah, so I actually still remember when I was first getting into syndication, I was listening to the Real Estate Radio Guys podcast, right? So that's how I found out about their event over in Dallas, and I flew out to that. But they're a great resource. They give out great education. I love all the Ken McElroy books, the ABCs of investing, the ABCs of apartment investing. There's just so many different resources out there. But I think my biggest lesson for newer investors is to focus on the downside. The upside will take care of itself if you're doing things correctly, but make sure you focus on the downside. Limit the downside risks, and the upsides will take care of themselves.
Yeah, that's great advice. Good deal. Very cool. If a listener wants to get a hold of you, learn more about yourself, possibly invest with you on your next deal, how can they reach out?
Yeah, the best way is just to visit our website. It's novocapitalmanagement.com. That's MGMT, and just set up a call. It gives us a chance to learn about each other, and for me to understand what people's goals and objectives are, and just see if we're a good fit.
All right. Jason, very good. Definitely appreciate your time today. Look forward to following you. We'll talk soon. Thank you.
Thanks, Josh.
All right. Bye.